Thank you, Sean, very much for those remarks. A huge amount in that, and it's great to hear from you. Also great to hear, representing the Commission. I think again setting the scene for our panel around regulation and supervision responding to change. And thanks to Sonia, who's introduced my panellists, who I'm delighted have joined us. Sean, I think I'll kick off with you because it'll be a continuation in terms of what you were speaking about there. And in the previous discussion with the governors, we were speaking about the context that we're operating a geopolitical, geoeconomic landscape. And you set out a kind of a very large programme of work that's done, will be coming to us soon. If you think about that, what do you think kind of really needs to be prioritised, in order for Europe to kind of maintain a resilient Europe, but also a competitive Europe?
Thanks, Mary. These are very big chairs. I think there are many things need to be done, but you have to prioritise. And I suppose if I was to prioritise, it would be the capital market. Why? Because as I said in my remarks, we have a gap in the financial system, which is now, for a very long time, and I know this because I've been working on this for a very long time, capital markets were seen as a nice to have in Europe. We had a nice banking system. Capital markets were an additional option. I think now what we realize is that, as I think it was mentioned by Governor Slippen as well, that when it comes to financial innovation, which tend to be, relatively small, initially small enterprises, but risky, banks are not so well suited to invest here. And if they were trying to do it, we probably wouldn't let them because we would charge lots of capital because it's very risky. So we need a direct financing channel. And when you look in Europe, we don't have it. We have a capital market which is very fragmented, relatively small and underdeveloped. The figures are quite shocking when you look at them. We have a market a quarter the size of the United States, but we have 300 plus trading venues. We have 25 CCPs, 30 CSDs, 16,000 asset managers. We're equipped with a lot of participants in a market which is not all that big. So just looking at it, you can see it's not so efficient. And therefore, we need to get scale into it because it's, if you boil down the Draghi report to two words, it is scale and innovation. And they're linked. We need to build scale in the system, and that scale needs to be able to take the risks around innovation. So if I was to put my priority, it would be on the capital market. And that's why, in a sense, it has been the first thing that we have done.
And I think we'll come back to a little bit of implementation in a little while. Maybe, Emma, and I should say to the audience, there will be an opportunity for questions. I want to leave enough time for that, 10 to 15 minutes. So do have a think about those. You can go through Slido. You can see in your brochures how to lodge your question. Emma, Ireland, small open economy, very internationally orientated financial service sector. In that context, we're operating around geopolitical, geoeconomic. How do you view that landscape, that evolving landscape?
Yeah, no doubt it's challenging, and we've had a long series of challenges, I think, actually, when you look back over the last decade. But I suppose if you look at the last few years, the war in Ukraine, I think, certainly led to for Ukraine, but also for Europe, a number of challenges, and the uncertainty that came from that, the energy, the cost of living, I think all fed into the political discussion. Layer onto that the discussion around tariffs, and this uncertainty started to feed the narrative domestically and at European level. And maybe while the uncertainty is down from its peak, we're still looking at very elevated levels. And I think when you look at the discussions that we have both domestically, but certainly, when ministers and senior officials go to Europe, they're different discussions than what we would have been having maybe 5-10 years ago. You hear a lot more discussion now about the multilateral world order, the role of institutions, discussions about defence, even defence in the finance space, the supply chain, protectionism. These were discussions we weren't having a decade ago, maybe. And against that backdrop is where we're looking at financial stability and resilience. So this is a challenge for countries like Ireland. It's a challenge for everybody, but it's certainly a challenge for Ireland. As you say, we're a small, open economy, large multinational sector here, large financial services sector. These are big employers, they're big taxpayers. We're very integrated into the global economy by them being here, but it gives us a very unique perspective and a very good understanding of what has happened is happening around the world and in Europe. And I think, we need to reflect on how we got to this point in Ireland and what has worked for us. So we've been open, we've been global, we've been flexible. We're very, these are things we've been committed to and we should remain committed to. We see the importance of strong, stable budget frameworks, predictable rules, openness, engagement. So we can still hold all these things dear, but we're not kind of operating in a business as usual environment as well. So we need to think about what we can do better. And I think some of them have been just set out by Sean. We need to think about how we do things differently at a European level, but also domestically, we need to think about what we can do different, what we can, how can we adapt, what do we control that we can change. I suppose we're fortunate and we're starting at this with a strong economy. Again, something not to be taken for granted, but it helps, certainly. There's been a big focus by the current government on competitiveness, kind of a national strategy on competitiveness, about the Ireland for Finance strategy, the funds review, the NDP plan, the setting up of the future funds. So it's about preparing yourself to deal with these challenges and the future challenges and looking at, the Letta, Draghi, SIU. But all of these are hard to deliver and they take a long time to deliver and they do come with some competing challenges. So we need to manage all of those. And I think we'll probably pick up on some of them about, what's our risk tolerance, what's our competitiveness. All of these things come into focus when you're faced with this new environment.
No, there's a huge amount in that. Thanks very much, and we will come back to some of those themes. Adam and Gráinne, I want to bring you in this in terms of, it sounds like I'm asking the same question to everybody, but maybe let's think about some risks and opportunities within this context for financial services, given where you both sit and what you both see. So maybe Adam first and maybe to Gráinne.
Thank you. Thank you very much for inviting me here. And I'm in danger, because you are repeating the question, I'm in danger of repeating some of the answers. I think I would identify one big risk, although, as Olaf said, we could all go with a long list. One, I think, in the current environment, one of the greatest risks is a further fragmentation of international capital markets in the financial services sector, and that's a danger for Ireland with its openness and with its economy. It's a danger for the EU as a whole, which is a very open economy in trade and services. It is a danger for the UK, which already left the EU and introduced fragmentation into the system, but it's also a danger globally and a major risk, because if we think of the role of international capital markets, which are inherently cross-border, one is to efficiently allocate capital globally, and also within the EU, and Sean mentioned the large savings of Europeans which are not allocated efficiently within the market or even globally. And the other big role of international capital markets is to allow risk diversification, or the spreading of risks. Now, if we introduce massive frictions into this by regulatory divergence or a fragmentation of the regulatory framework, the global standards, the mutual recognition or equivalence procedures, market access rules, supervisory expectations that are localized, macroprudential policies that are severely localized, then we are introducing friction costs into both capital allocation as well as risk management. So I would say this is one of the major risks we are seeing today in the current geopolitical environment. Now, if you want to turn it to opportunities, I would mention two. Again, we could have a long list. One is, and it was mentioned by the governors very eloquently, is that this can help to build momentum in Europe to actually take action and improve what we can improve, what is under our control, and that is the integration of the European market. That can also lead to, for example, a momentum behind the UK and the EU to sort of reset the relationship or improve the relationship in financial services, and I'm trying to limit myself to financial services. But it also gives the opportunity globally to find the jurisdictions who are willing to continue on the basis of law and order and international rules to cooperate deeper and sort of reinvigorate the functioning of cross-border markets. But I think the first opportunity and the first challenge we have is to fix what we have within the European Union. And the second opportunity I would mention, and there will be a panel on this later on, and several former speakers mentioned this, is the sort of the development of a DLT-based capital market, which would use a technology which has got many use cases. Some of them are economically not really appealing. Some of them are very appealing, but it is a technology which can contribute to revamp the entire capital market infrastructure, including retail and wholesale services. And I'm happy to go into that in more detail, but again, I don't want to cannibalize the time.
That's okay. The job of a moderator is to ensure nobody cannibalizes the debate. Gráinne.
Thank you very much, Mary Elizabeth, and thanks to the Central Bank for inviting me today. And it's great to see such a huge turnout. To avoid the risk of repetition, and I echo all of the comments that my fellow panelists have made here, I kind of looked at things through a slightly different lens in the context of opportunities and threats. And where we see opportunities, I see three mainly in financial services. And one is definitely the flight given we've had such volatility in markets over the last number of years, we do see a flight to quality and a flight to fixed income. And that's something in a trend that we've seen over the last 18 months and 2 years, where we've seen steady returns, steady quality of investments in fixed income markets, and particularly in bond markets, which actually serves as a good stabilizer, I guess, given the volatility that exists elsewhere. And this is something that we would definitely see as an opportunity for 2026 and beyond. We've also seen an opportunity in the context of credit markets, and credit markets can be very fast-paced, as we all know. But we've definitely seen growth in the private credit market. And again, this is something to be welcomed as an alternative strategy and maybe an alternative source of finance. And again, we see this, while there's certain questions sometimes around the underwriting of credit, etc. By and large, we see huge opportunity here where you lean into the more stronger, more resilient credit. And again, that is something both for investors and for financial services firms more broadly. The third opportunity I'd like to call out, and I guess we will hear a little bit about this today, is in the whole space and the area of artificial intelligence. And I think for investment firms and for financial firms more generally, we see a huge take-up of AI in our day-to-day interactions and operations. And it brings huge benefits, as we all know. So we can see it in terms of enhancements of research tools, portfolio analysis. We see it in the context of maybe helping communications with our clients, etc. And we see it very much in the operational space. But I think it's important not to forget that the human in the link is incredibly important. So we utilize AI day in, day out, but that human judgment has to be really factored in, and that's not something that can be easily replaced by sophisticated tools in IT. I suppose not to end on a downer, but I do think the question was focusing on the risks as well. And I loved the answer from the president of the Danish Central Bank. So I wanted to change my answer, but I won't do that. I'll stick to my guns. And I totally agree with what you're saying as well in terms of a risk. But for us, I guess, from an operational perspective, I do see cyber continues to remain a key and critical risk for financial service firms. And I think it would be remiss of us not to keep it front and center. We hugely rely on digital tools. We rely on cloud storage, etc. And we all know that hackers are getting far more sophisticated in terms of their ability to access our data, to be disruptive to our operations. And I just don't think complacency is an option here. We've seen a huge amount of focus on cyber over the last number of years by regulators. And you know what, if you're not looking at this front and centre, it is going to bring reputational risk for firms, it's going to bring significant cost and confidence in financial services sector. So for that reason, I would still continue that the focus on cybersecurity needs to be front and centre.
No, I think we could all agree with that, just in terms of that kind of operational resilience aspect and more generally. Gráinne, can I stay with you and we'll kind of go into a round of maybe just in terms of Europe's strategic priorities, and Sean outlined kind of where he would be placing emphasis. I suppose in terms of your discussions within the funds industry, what key changes or initiatives, and maybe we can guess those from the way the discussion has already been going this morning, would you say are of greatest importance for the industry?
Yeah, very fair question. And I think there's a lot will be spoken about this today, and we've heard a lot already this morning. But I think there's important, I suppose, to recognise the objective of the Commission, the strategy, the strategic direction, and the energy that's actually in Europe at the moment around reform and real reform. So for me, I think of three key initiatives, and coincidentally, they all begin with S, so I'll start with my first S, and that's going to be the Savings and Investment Union, which John spoke so elegantly about earlier on. And I just really think that if we're going to achieve the desired objective of the Commission, the Savings and Investment Union is a cornerstone in this regard. There has to be something that facilitates and enables household savings into real and productive investments. There has to be something that addresses market fragmentation. So I think the ambition and drive behind this is absolutely critical. The second is, I suppose, one of the priorities, and John mentioned this earlier as well, in terms of actually delivering the Savings and Investment Union. And for me, it's around the securitisation reform. I think that has been a really well-chosen priority, because I think Draghi and Leto both called out, I suppose, how far behind Europe is when you compare it to the US in terms of annual issuances of securitisations and securitized markets more generally as a percentage of GDP. So I think something real and tangible actually has to happen there. There's a lot of work being done in terms of enhancing transparency, improving due diligence, simplification. But I think it's important from the funds perspective, because John did call out the benefits for banks, and we all know that banks and insurance firms do participate in securitisation markets, but equally so too can investment funds. And I think they can really help in terms of picking up the demand side of securitisations. And for me, it's actually an excellent conduit, because it allows investors access to securitisation markets through a well-regulated and well-functioning investment structure. And the third priority, and again, I know we're going to focus on it shortly, so I won't dwell on it, but it's my third S, and that's very much around simplification and proportionality. And we know the Commission's objective here was really to not to take the burden out of regulation in one way, but by at all times maintaining and preserving investor protection, in preserving market integrity, and in preserving financial stability. And I mean, really, who can actually not agree with that? I think it has to be a desired objective of all of us.
Thanks very much, Gráinne, and we will touch on simplification. Adam, what do you think?
Very similar. Very similar. I think for the European market, one key objective should be to increase retail participation in capital markets, and not just direct retail participation, but also through instruments that are facilitating and attracting retail investments into capital markets. So I think in that sense, some key proposals, and I would refer back to Sean's list of what the Commission has come up with. The retail investment strategy, which is very close to finalization right now, was a critical piece in that. The pension reform proposal, which was published very recently, I think it will be a massive impact if it succeeds with its objectives. Even if personally, and this is my personal view, it could have been more ambitious, as we all know. But if one looks at the big difference between the US market and the European market, one striking difference is the lack of sufficient pension investment in Europe in capital markets. So that's a critical one. And then the third one I would mention is the package of proposals which will come in early December, the market integration package, where hopefully there will be some measures that will make markets more efficient and cost-effective within Europe. Just again, one example, we recently published a report which shows that post-trade costs, and that includes, eventually that is borne by the end investors, are about 75% higher in Europe than in the United States. We looked at this with full evidence. So anything that can improve that would be fantastic. The second big priority I would mention is banking union. I could not agree more with what Sean listed there. I wouldn't want to repeat, but clearly European banks are less competitive, less profitable, smaller. They cannot scale up even within Europe. We did an analysis which shows that above roughly 450 billion of size, they cannot benefit from growing their economies of scale within the EU because of the fragmented market. Again, happy to go into the details on that.
That's perfect.
And then the last one I would also mention is securitization. I fully agree. It was a comprehensive package. It impacted all aspects of the market, and it is actually one example where the EU is clearly doing much better than the UK, despite the fact that it's a single jurisdiction. But the UK is following a very piecemeal approach in looking at securitization, whereas the EU package was really a comprehensive one, looking at all aspects of the markets: demand, supply, transparency, prudential, liquidity, insurance, banking, so the entire ecosystem.
Well, thanks to you both for those perspectives. I want to touch on the presidency in a moment, but maybe just to go to Sean before we touch on simplification. And thank you for submitting your questions, because I'm getting a lot through here, kind of touching on the simplification agenda. So, Sean, I mean, I think we've heard in terms of what will make a difference, what's already making a difference, what's anticipated that could make a difference. And I was struck by the President's kind of real risk, the kind of failure to act. And it seems that there's, consensus, there's momentum here. But what's the biggest challenge, do you think, in actually delivery?
I think the challenge is the same as it has always been. I mean, the context is more stressful now, but the challenges are a bit the same, and that is that the benefits of integration, certainly at the EU level, are fairly diffuse. They're very widely spread. So there's really nobody, apart from my good self, who champions them, from the Commission point of view. Whereas at the national level, of course, the costs can be quite concentrated. So there will be a lot of, there are vested interests involved here, and they have to be addressed. They have to be confronted. So that means that all of the things that I easily list off here, and when I'm standing on a podium, involve serious political decisions. Sensitive political decisions. I mentioned supervision there. I was telling you earlier, there's a degree of religion around supervision in the European Union. These are all very politically sensitive discussions. So I think it's not that the challenges are more or less. I think the context is very different, and the context is much more, as I said, demanding. So I think there is a risk of inaction, but if you zoom out and look at the context we're in and the challenges that the EU faces, I think the time has come for those politically difficult decisions. But of course, that still remains a challenge. That is easier for some. It's easy for me to stand up on a podium and tell you what I think from a macroeconomic, macro-financial point of view is the right thing to do. But of course, they have to be enacted on the ground, yes, and they require political courage.
No, sure. Courage was a point that the Governor made in the previous session. Emma, so we're going to take over the presidency in H2 2026, a time when we have maybe some of these files coming to a fairly mature stage in terms of their kind of landing zone. The role of Ireland as the kind of honest broker is incredibly important. What role do you see for Ireland in kind of shaping those priorities? I know we don't know exactly yet the files that land, but we're getting more of a sense as we get closer.
Yeah, so on 1st of July next year, just over 7 months ago, we will take up the presidency. We have been planning for this for quite a while. So we'd have looked at President von der Leyen's strategic agenda. We've been looking at the work programme of the Commission. At this stage, you know, there's things you can almost be certain you'll be dealing with, and there's sort of things that are sort of, you know, will not be solved by, the Danish and the Cypriot presidency. So we'll be, you know, we know we'll be dealing with Ukraine, we'll be dealing with, you know, international economy, the MFF, the end of the Recovery and Resilience Facility, but also, you know, Sean has just outlined a very large programme of work in the financial services side. I suppose the thing that it's as we get closer, we'll know exactly where the files are at the point we take them on. But we have a fair idea at this point. I suppose the one difference about this presidency compared to our previous presidencies is actually it's a second half of the year presidency, which we're used to a first half. Second half brings one extra complication. You've less weeks effectively to do your business. You could really bring it down to you've about 4.5 months. You know, that means you have 4 ECOFINs and an informal, you've only a certain amount, you know, we will have to maximise what we get from every day of that 6 months if we want to deliver on our presidency programme. So you start well in July and you bring it right up to Christmas, and you need to maximise what you do. I think through the system we have a very clear understanding of what it takes to be a good presidency. There's a lot of training going on around the system about what it is to be an honest broker. I think for small countries there's a real pride in delivering on a presidency. I think we come at it with a good knowledge of what we're dealing with. We'll have good technical expertise. We're working very closely with the central bank, who will support us in delivering on the various files that Sean wants us to deliver over the course of next year. But we also have a good understanding of what it requires, you know. So there'll be the view of, you know, member states, there'll be the view of the Commission, and then there's the view of the European Parliament, the views of the industry. We need to we know we need to work with all to deliver on them, to deliver kind of the best for Europe, but also I think to set us up for the future, you know, and for future presidencies. And we are working very closely with currently the Danish presidency and with the Cypriots in the first half. But ultimately it will be just before we take it up, before we will actually publish the specifics of the programme. Because, you know, you take up wherever the last person left off.
No, thanks for giving those insights, and also the kind of continuum associated with the various different presidencies in terms of how it moves. I think that's helpful, and also no pressure then in terms of really 4.5 months. So we'll all be working very hard. So there's roaming mics as well. So I'm going to touch on simplification, and I'll build one of the questions that's here on so I'll be democratic in terms of the iPad, and also if you have a question, just raise your hand and we can get some of the team to go to you. So Sean, you know, not a week goes by where I'm not in a conversation that maybe touches on simplification in one way, shape or form, and I'm sure it's quite similar for you. And you spoke in your speech in terms of that kind of careful consideration and balance in terms of how you're approaching it. So I suppose, how are you thinking about getting that right balance? And you mentioned kind of resilience in terms of a first and last line. Maybe you talk a little bit about this, and can I fold in a question in terms of from the audience, which is saying, is part of Europe's problem that we always think about changing the rules more or less is the answer, and will the legislative packages really address our productivity problems? So I'll go to you first. Thanks.
Thanks. I think simplification is a bit like stability. We prefer to define about what it's not than to define about what it is. So we know it's not deregulation. That's clear. So what is it? I mean, well, first of all, it has many terms. So we call it simplification. The United States calls it modernization. It has been called burden reduction. It has been called streamlining. There are a multiplicity of terms. My definition from it is optimizing the efficiency of the regulatory framework. So optimizing this balance between efficiency, growth, competitiveness, and resilience. So conceptually, nobody can be opposed to that. But in concrete terms, it gets a little bit more tricky about where you actually put that cursor. And I think the way we are going to go about it is to make sure that everybody is around the table, because if everybody's not around the table, we could end up with an unbalanced or biased outcome. So I think it's really important that not just, I mean, I'm kind of schizophrenic here. I'm a trained economist, but I'm a product of the great financial crisis. So I kind of worry about growth, but I also worry about what happens if you try to push the system too much in the favor of growth. So But we need to get everybody around the table. So this is why we're going to consult quite widely and try to find what is the kind of consensus on this balance based on evidence, based on informed opinion. But I have to say there's a few paradoxes around simplification that I've found. First of all, it's not simple, it's complicated, quite complicated, the simplification debate, when you get all these people around the table, because, well, you'll never get two economists to agree, and you'll never get two supervisors to agree either, I've discovered, so that's also something. Also, simplification actually requires more regulation. And this gets to the question that you've just posed. In order to simplify the law, you have to open the law. You have to re-regulate. So simplification ultimately is where you're heading, but the process can be, and anybody who's following the CSRD through Parliament can see that this is a process where you open regulation, and of course, you like to think people only focus on the bit that you've opened, but they can focus on whatever they like. And so the point is well taken from the floor that I had hoped in the last mandate to have a stable mandate this time, because the market was calling for stability in the framework, and I happen to agree with them after 15 years of industrial production and regulation. But simplification has now required that we nearly reopen the entire framework. So there is a trade-off, I think, between trying to get a simplified framework and having a stable framework.
Yeah.
And that's a choice that, again, people may differ on, but we have opted to go for the simplified approach. But it will mean that the framework will be unstable for
a period.
For a while.
That's the trade-offs. Thanks, Sean, for that. And I think it's good for people to hear that in a little bit of a drill-down way. Emma, I'm going to fold in a question here that I have on the iPad as well. So how's the department thinking about simplification and competitiveness in Europe, and how do you think you can achieve that balance as Sean was speaking to? And again, let me fold in a question here in terms of regulatory layering referenced as being difficult to navigate. What more can be done to legislate from Europe and reduce national approaches, which I, as the legislator, and I suppose I have to say two things. I find you can agree as a supervisor, just to your point. There's a few supervisors in this room that we do try and reach a consensus from time to time, so I have to say that.
So can economists eventually.
Emma, please.
Like simplification has become something that's at every meeting now. You know, it has become a key word that is being mentioned. And it's, to be honest, domestically and at a European level. And, credit to the Commission, they've really had an impressive, series of packages on this. And I think they're moving, quickly through the Council, maybe a little bit more slowly through the Parliament. And I think we're all agreed on what it is, in the sense that it's about, reducing the admin burden. It's not deregulation. It's not at the expense of financial stability. And effectively, I suppose, it's about delivering the same outcomes, but in a more straightforward, easier way, reducing complexity, etc. But actually, I think when you go a bit deeper, it's sometimes harder to get agreement. So everyone agrees they want simplification, but everyone has maybe a different idea of what simplification is. And I suspect if you ask the institutions, it's one thing. If you ask the citizen, it's a different thing. Or you ask industry, it's a different thing. So simplification is it's not particularly simple. And I think certainly the Danish presidency at the moment has put a big focus on this, and it was a big topic of the informal ministerial finance minister. A new financial presented, and they put up a really interesting chart which was looked at, regulation under level 1, level 2, level 3, and it was quite breathtaking actually, just at the amount of regulation that we have in place and then the layers that are there. But I think I would probably distinguish it into two ways. There's the backward-looking simplification, and then there's forward-looking. So there is a body of work, which is where we need to look at what's in place at the moment. Where does it need to be simplified? Where's the evidence showing us that it needs to be simplified? But I think we need to be careful that we're not creating uncertainty by doing it, because it could give this sense that everything is up for grabs again, and it's not. We're not reopening settled policy. It's about, doing things a little bit cleverer. But I think there's a lesson as well for the future work. So, let's not find ourselves in this space again in another 5 years. So the next 5 years' work, we have to do it in a way that actually we get it, proportionate and right. And we do that by thinking about what we bring forward, I suppose, how we engage with industry. But so the Commission proposal needs to be right, but we have a responsibility in Council then to not add more layers, because let's be frank, some of the complexity that's in the system has been added through the need to get compromise over the years. And then the package goes to the Parliament and more gets added there. So at each layer, we need to be careful to keep it simple. And then there's a real responsibility on the ESAs and the national competent authorities to implement it in a way that is not adding to the burden. And that includes us not gold plating as we go along. So I think it's clearly a key thing. It will be a key component of our work now. It'll be a key component probably for a while. But I think we should try and not make it too complicated.
Understood, and therein lies the challenge. Adam Gráinne, let me come to you in terms of just, it's also a key focus for the industry. So, Gráinne, do you think the burden reduction but standards maintained, do you think that's something that industry...
Big time. I think that's really important. And again, I would echo strongly the views expressed by others on the panel. This isn't about reducing standards. And I think it's important that we all remember financial services firms right across a multitude of sectors and investors place a huge reliance on what it means to be regulated. And that, both from a provider of services and products, having that badge of regulation attributed to those products, and even from an investor perspective, the confidence that it's instilled, that knowing that you're dealing with a regulated entity and you're acquiring regulated products, that should not be forgotten as part of this debate. So I think that's really important. I would echo a lot of the comments, Emma, you made. It's really difficult to achieve. It's this huge ambition there, so it's anything but simple, to pardon the pun. But for me, I guess, if you think about what good might look like, it's very much around avoiding market fragmentation, you mentioned that, avoiding gold plating and unnecessary maybe nuances between various different member states. And I suppose ultimately providing some degree of predictability maybe for operators in financial services, in financial services and financial markets, I think. Yeah. For me, I think the ultimate aim here is around smart regulation. That's how I see simplification. If it can really deliver on smart regulation, which is really writing rules that address policy issues without overly or unduly adding operational costs. I think that's really where industry are looking at this from that perspective. And I really think, albeit a huge task, simplification can really achieve that.
Thanks, and I think that's what Emma's speaking to in terms of the forward-looking piece about how you, and thinking about the end user in mind. Adam, would you like to add? And then I'm going to have you think, someone in terms of the panel that's come from the audience, are we seeing over-regulation as a result of the crash, and that is impacting the union's competitiveness and how businesses function? So maybe you can think about whether anyone would like to say that. But Adam, do you want to just come in on the...
Try to answer that question.
Okay, sure.
I think I will try to give a specific example and a more, let's say, abstract or high level example. I think the specific example would be banking, and Sean mentioned that the Commission is preparing an assessment of the state of play of the banking system in Europe and seeking for input from all stakeholders. So this is just this could be part of that. Today, a significant bank, a large bank in Europe, would need to manage its capital according to 8 or 9 different capital stacks. So, and each of these requirements have their own reason and purpose to ensure resilience, but it's just overly complex to manage and optimize or allocate capital according to requirements defined by 8 or 9 different stacks. The second one, just along the same line, for resolution purposes, a large European bank would need to meet MREL standards as well as TLAC standards. They are all serving the same purpose. They are coming from different sources, but there are just 2 standards to do that. Resolution fund contributions. Again, it's a justified policy objective, but it's not sufficiently transparent. Therefore, it creates a lot of complexity and uncertainty in the market. Then interference into consolidation, and we have got recent cases where the Commission is trying to step up the enforcement of that. Or the interlinkage between microprudential and macroprudential measures, and the different authorities who are operating these tools are resulting in excessive complexity in banking. I didn't say anything that would undermine the stability or the resiliency objectives. It is just simply too complex as it is today, and it reduces the resources and the possibility for European banks to compete. I agree with the comments earlier that banking regulation is by definition complex because it's a complex ecosystem. But still, I think there are opportunities to achieve some simplification. Now, the general comment I would make, and I would move out from the banking space, is what we see as an issue in the European framework is that there is too much prescriptiveness and complexity at level one. In the level one, and that gives any country who's coming up with the presidency a sort of nightmare that we have to use every single day of that presidency to get something out. Does it need to be the case? I would doubt that it would be better off to have a little bit of less intensity in level one, less detail in level one, and more delegation to lower level regulators and supervisors with specific harmonization and clarity at that level. That's a big change what happened in the UK after Brexit, the massive delegation of powers to the authorities. We all know that cannot be repeated in Europe in full, because one of the purposes of detailed level one is to achieve harmonization or consistency across member states. So that's not, I think that's not a realistic ambition.
That's fine. So we're in a dangerous place because we're standing between the audience and their cup of coffee. So I think, but does anyone want to just, I mean, the touch on the overregulation point, anyone want to pick that up in terms of Sean?
I mean, just one point on it. I mean, I don't for 1 minute suggest that everything we have done since the great financial crisis remains necessary, we can do without. Just an interesting thing to think about. I have CEOs come into my office demanding principle-based legislation at level one. They're followed by their own compliance officers who come in and tell me they want legal certainty. If any of you can square that circle for me, I'll leave my email somewhere and you can send it to me, because it is in fact the problem we face. The top guys like principle-based, the compliance officer like certainty, and we can't deliver both.
No, we can't. And one final comment from the audience to say a UK neobank entered the EU in 2017. It now has 40 million EU customers. This shows the barrier to banking union is in the bank boardrooms more so than in regulation. So just to be fair, because I didn't see hands going up in terms of representing the comments, I really want to thank my panel very much. We covered an awful lot there. We could have gone on, but just say huge thanks to you for coming and for your contributions. Much appreciated.